We're in the post-pandemic recovery and investors are still worried about where to give a shot for the long term. Well, if this is you, then this video is specifically meant for you. Be sure to watch till the end and I'll keep you posted on the best blue chip companies to invest in. Hello everyone and welcome once again to this channel. In today's video, we're going to look at the top 8 blue chip stocks with strong numbers. And as we all know, you can hardly go wrong with blue chip stocks. Why? Because the companies behind them are high-quality companies with a solid balance sheet and consistently make a profit whether we are in a rising or falling market. So, make sure to subscribe to our channel and hit the notification icon to never miss out on any of our latest episodes. And let's get on with the video. Number 8, we have Caterpillar. Talk about machinery giant, and Caterpillar comes to mind automatically. Caterpillar is renowned for manufacturing top-quality machinery and engines from scratch, marketing and selling the same to clients. The company, which has established a wide stream of income, also cashes in from selling financial products and insurance to customers through a chain of dealers around the world. That gives the company that originated from the 1925 merger an upper edge against competitors. Today, Caterpillar has grown exponentially, establishing itself as a blue chip and has managed to stand against market forces. The American heavy truck manufacturer has largely exceeded analyst earning expectations in the last 2 quarters. During the last quarter, the company exceeded Wall Street's share earning prediction of $1.94 per share by nearly 48%, coming in at $2.87 per share. The price has risen by about 45% in the past 6 months and has recently flattened. Caterpillar has been working hard to recover from the corona crash in March, moving up a lower share price of $95.50 to the current trading price of $240. The machinery giant, which is currently valued at slightly above $131 billion, has been experiencing a steady uptrend. Even though this may trigger you to buy into it, I can sure say the stock is almost at the peak and it's beginning to stagnate. Therefore, buying it at this moment may not be worth it. However, if you invested in the company way back, the best you can do is hold on and exercise some patience as your dividends compound. At number 7 is Facebook. Social media giant Facebook is one company that can never miss on this list. The company, which began merely as a community communication means among Harvard University students, has grown fast to attract over 2.8 billion active users monthly. Founded in 2004, Facebook has managed to take advantage of the post-pandemic recovery to drive its share value higher than anyone would have expected, and now the company is trading at $305. During the previous quarter, its sales went up 50% after the company recorded $9.5 billion in earnings, representing a $3.30 per share. Now that was almost $1 above analysts' estimates. Although the stock is up more than 50% in the last 12 months, Facebook is still fairly cheap compared to other tech giants. So this gives you a good reason to pump in a little more Facebook. Why do I say that? The reason is pegged on the current market dynamics that are expected to skyrocket the value of a majority of tech companies. As many people continue moving online for networking and entertainment, we expect this to be the norm even beyond COVID-19. And that, of course, will help Facebook to achieve double-figure percentage earnings from digital advertising, e-commerce, and virtual reality. Coming in at number 6 is Alphabet. Alphabet, the parent company of Google and YouTube, has continued to evolve to catch up with the current technological advancement. It is a company that has shown good historical performance, and its valuation stands at a staggering $1.51 trillion, and as such, it has been rewarding shareholders good dividends from its huge quarterly profits. This high-quality blue-chip company has diversified its revenue portfolio and now owns a wide variety of products, including self-driving cars. Just like Facebook, Alphabet is benefiting hugely from the current economic pickup and advertising revenue. With the total turnover increase of 32% and a doubling of the operating result year-on-year, this share, currently trading at $2,229, is far from being at its peak. Having recovered fast from the 2020 crash, Alphabet has taken a stable uptrend to double its share, leaving investors with more confidence to buy more shares. Well, that should be enough reason to drive away speculation and get you down into action. And that's buying and holding more of Alphabet. At number 5, we have Johnson & Johnson. Johnson & Johnson, which achieved the coveted Dividend King status some 8 years ago, is a blue chip to keep in mind as you speculate invest. The company, which is quickly diversifying its revenue portfolio, is slowly but steadily recovering from the 2020 crash and has managed to drive its share price to the current $170, up from the March 2020 price of $120. Compared to some of the other blue chip stocks on this list, the sales growth of this American consumer goods giant is perhaps a bit more modest. But with $2.59 per share earnings, that's 10% above expectations. This is one low-risk stock to consider. Johnson & Johnson, which has a market capitalization of slightly above $447 billion, offers a nice dividend yield of 2.49% to its investors. It's indeed a quality company that you can invest in and expect good earnings in the future. Why? J&J has been here with us for a long time. It's relevant, its product range will continue to grab attention and will, with no doubt, pay investors. At number 4 is Lockheed Martin. Well, Lockheed Martin is the world's largest defense company with the majority of its revenue coming from the U.S. Department of Defense. The company, which was formed through a merger in 1995, trades at $388, and it's on a move to restore the stock value to where it was before the crash. It has a market capitalization of $107.8 billion, and this is expected to increase further considering that Lockheed Martin has decades of expertise and experience, which gives it an edge over competitors. With a forward price-earnings ratio of 14.3%, this U.S. defense company is considered undervalued compared to other high-quality companies. However, with a 2.73% dividend yield and fairly strong earnings numbers, this is one company you can build on. Moving on to number 3 is 3M. 3M lands on this list as an industrial powerhouse whose products span technology and healthcare. Having been around for over a century, 3M's products are valued by many people due to the company's edge on invention in health and safety products. Despite its dividend aristocrat status, the 3M stock price halved to $125 in March last year due to lack of growth. But if there's one company that has recovered well from the aftermath of the corona pandemic, it is 3M. The price has risen by as much as 60% during the corona dip and now trades at $203, and it's expected to rebound to its value before the crash. The continued strong earnings numbers have helped restore investor confidence in the company. By considering the historic performance of 3M stock, we can therefore say that this stock is worth investing in at this moment since it's yet to hit the peak. At number 2, we have Microsoft. Talking of a money-minting machine, and Microsoft it is. It's a well-managed blue chip that's well-represented and its sales are predetermined. This software giant of yesteryear is currently crushing the competition with its cloud services. The stock is up 40% in the past year, but due to the high quality of business and the popularity of cloud services in many industries, it will certainly see further price gains in the future. Looking 5 years back at Microsoft's performance reveals a bullish, stable uptrend that has seen the stock value rise to the current $243, up from the $137 during last year's crash. With this positive momentum, you can for sure invest in the $1.8 trillion valued company without a blink. And finally, at number 1 is UnitedHealth Group. This U.S. healthcare giant has far exceeded last quarter's earnings expectations. Still, healthcare stocks are underperforming this year compared to the rest of the market. UnitedHealth Group has recovered fast since the crash to hit the current $409 share price. However, after the price rebound in 2020, we may see less dramatic gains for UnitedHealth stocks in the coming years. But as a blue-chip company valued at $385 billion and operating in an industry that is less vulnerable to economic downturn, this is a high-quality stock to hold on to for a long time. So those are your top 8 blue-chip stocks with strong numbers that you can consider investing in for good returns in the future. But as always, guys, these companies are not going to make you rich overnight. You must exercise patience as you watch your dividends compound over the years. Which other blue chip stock do you think we forgot to mention on the list? Let us know in the comments section below. I really hope you enjoyed watching this video. If that's so, kindly give it a like and don't forget to subscribe and hit the notification icon for the latest episodes. Thanks for watching, have a great day, and I'll see you in the next one.